good morning, and thank you for joining us. My name is Janell McIlwain. I'm the team leader of Samson Property. The McIlwain Group of Samson Properties, and our team has two very special guests that we will be talking about with a very important topic. We're talking about navigating home ownership after divorce. Our guest, Ms. Breanna Colon, she's the host of the podcast Your Life, Your Money, and James Adamson, Ameris Bank. Let me first thank you all for joining us. It is indeed it's indeed a pleasure for both of you this morning. Let's first talking with Breanna. I know you have some great insights and some wisdoms that can help people when we talk about things they should be thinking about during this difficult time in navigating through the divorce.
Absolutely. Good morning, everybody. What's up? Happy to be with you today. I am going to share my screen with you, and we will get started with a little brief presentation. All right, hopefully everybody can see that. I'm gonna move things around a little bit here. There we go. Right. All right, as Janell stated, my name is Breanna Colon. I am the owner of Integrity Financial Solutions Incorporated. I am also managing partner for Right Time Financial LLC. Integrity Financial, we are a financial service and education company, and our mission is to help our clients to get to the place of financial freedom. And so we do that a lot of different ways. We work with a lot of different clients that come from all different walks of life and ages and stages of their financial journey, and to include those that have been through a divorce. We definitely had some experience with clients that have gone through that and have been able to recover and been able to get to a better financial path. So just a little bit about us as a company. As I mentioned, we offer financial consulting services. We do some help with student loans and mortgage savings, auto loans, et cetera. And then we also help with life insurance, disability, long-term care, and IRAs. With Right Time Financial, we do more of the advanced financial planning and investment side of the coin. So we're really kind of a one-stop financial shop. Just a little bit about me, a little bit over 20 years in the industry, in the financial industry. And before that, I was actually in accounting. So really have been just involved in numbers for quite some time. I am also the author of a book called The Secrets of Saving Money, Experiencing the Unlimited, and have definitely spoken at many different events, just continuing to encourage and motivate and inspire people around the area of finance. So today, I want to talk just briefly about, are you ready financially to buy a house? That is so important. Usually the first step when you are preparing to purchase a house is, let me get pre-qualified from the lender, which of course is very important. And the lender is going to qualify you based on your gross income and tell you, okay, you qualify for 350, 400, 500, or whatever the amount is. However, that is just one step of the process. The other and most important step to that is making sure that though you're qualified for one amount, let's make sure and be clear about what you can actually afford financially from that standpoint. And a lot of times with some of our divorcees, they have sometimes have leftover baggage, if you will, financial baggage. Sometimes there were debts that were joint debts, and sometimes there's things that have to be negotiated and some items that need to be cleared off of credit. And so all of those things are important to make sure that you address. But now also having that transition of maybe you owned a home before with your spouse, and now you're having to purchase a home on your own, just making sure that you walk into it as smart and as ready as possible without ending up being house poor. And so generally my rule of thumb as an advisor is to not purchase more than, have your mortgage payment be more than 30 to 35% of your take-home pay. Again, as I mentioned, we get pre-qualified based on our gross, but we don't live off of our gross. We live off of our net and what's actually hitting the bank account. And so from that, you want to just make sure that if your take-home pay is $5,000 a month, when you look at your money on a pie, how much of that do you want going out to your house payment? Don't you want to be able to do some other stuff too? You want to be able to live and travel and just enjoy life and family. And so, that being the case, so often people don't take this step to look at their actual budget to be able to see, can I actually afford this $500,000 house that they pre-qualified me for? And how much is the mortgage going to be? How much is the HOA? What are the other housing expenses that are going to be associated that I now have to be prepared financially to take care of by myself without my spouse? And so it can be done. And with the right financial plan, you can do anything, anything. It's already enough dealing with the mental side of things that come along with having gone through a divorce. But it's encouraging to know that that's just a chapter that you close, and now a new chapter can be opened, that now you can be successful where you are now. Yeah, you went through divorce, that was then. But what about now and going forward? How can you be successful, not just for buying a house, but for everything that's going to happen after you get into the house? Thinking forward to, okay, I'm going to buy this house, but let me think for a minute. I'm going to have this mortgage potentially for the next 10, 15, 20, or 30 years. What else do I need to consider that might happen in my life during this window of time that I'm going to have a mortgage, that maybe I need to consider before I say, oh, I'm going to buy this much house? Do you want to be able to retire comfortably? Okay, well, are you leaving enough room and flexibility when you buy this house to make sure that if you need to add additional to retirement, that you're going to be able to do that and not be so strapped that you got a beautiful house, but now you can't even retire because you got to keep working so you can pay for this house. So you want to be able to get in the house and be comfortable. And not only that, sometimes people want to be able to do other things. Like, I want to be able to buy a vacation home or be able to buy an investment property at some point in time in the future. And so you still have to think about, are these things on my radar? Are these things I would love to be able to do? Well, then let me think strategically about, how do I position myself so that I can buy this house that I'm going to live in, but now also prepare financially in the future for all these other goals that I have in mind. And so part of that process is starting with having a budget. And a lot of times we meet people all the time who make good money, but don't always have everything they need to show for it. And so part of that's your financial foundation, is having a written plan of what's happening with my money every month. And so I know that sounds really simple, for particularly to those who may already be doing that. But if you are not already doing that, and sometimes people will have a budget but don't actually follow it. That's two different things, right? So you got to do both. You got to have it written and you got to actually look at it and follow it. And so having that written budget, you're going to just look to see, okay, well, how much income do I have coming in? And what things do I have to pay based on the pay period? So if you're getting paid weekly, you need a weekly budget. If you're paid every 2 weeks, you need a every 2 week budget. If you're paid once a month, sometimes people try to use that as an excuse. Well, I'm on a fixed income and still money coming in. You can still have a plan no matter what, how your money is coming in. It's not about the money you make, it's how much you actually keep. And so when you're writing that budget out, you want to write, I get paid, $5,000 on the such and such part of the month. And then you start listing out, these are the things that have to be paid on this date, and start subtracting and figure that out. You have to have a budget for your groceries. You got to have a budget for how much you can spend. A lot of times for many of our clients, we see the issue is not necessarily them paying the bills. The issue is how much they're spending afterwards. It's just the frivolous spending that's kind of getting in the way of them being able to achieve the goal of being able to buy a home, or the goal of being able to buy a car, or the goal of being able to retire. The money is just not divided up properly on the pie, and it's just out of proportion. So it's really important for you to have that budget. But also, what's equally as important is having adequate savings. When you're purchasing a home, and especially if you're coming out of a divorce situation, sometimes we've had divorcees who don't have any money saved because everything was spent trying to move, trying to just resituate and start a new chapter. And so that doesn't mean that you can't start saving from where you are. So you have to figure out, how much can I save? Which goes back to number one. If I don't have number one, then how am I going to figure out number two? So you got to be able to figure out, even if it's $25 a month, you got to be able to set aside. And if you're going to buy a house, you also have to be able to have money saved. We don't want you to just get in the house. We want you to be able to stay in the house. And in order to do that, you've got to have enough money saved to make sure you can cover your down payment going into the house, any closing costs, any costs that are incurred during that home buying process from your appraisal or your home inspection, any of those things. You need to be prepared to pay for those things, plus the cost of moving. Even if Pookie and them are moving you still got to have enough money set aside to cover getting Pookie and them some pizza. You got to pay the moving company. And then when you move in, you're gonna want to buy some curtains, and you might need to buy some appliances. You might need to buy some furniture. Now, keep in mind, you don't have to buy everything at once. Sometimes when people have gone through a divorce, they are literally starting over, and they may not even have all the same furniture that you had before, and that's okay. You don't have to go out and buy everything all at one time and then go into debt and you just got in the house. That's a disaster. That's a recipe for disaster and setting you up again to be house poor or to just be broke or be in debt all over again. And so the smarter move is just to be more practical and say, okay, maybe I take one room at a time. Maybe I just say, let me start with the living area, the common areas where I might actually want to have some friends over. Let me at least get a sofa, But the point is, you got to be able to save for those particular items. So you want to make sure that you set aside for that for after you move into the house. And then, what if something breaks? What if you got to repair something? What if you just moved in? This is a used house, and now even if you have a home warranty, it's not a guarantee that they're going to cover everything. So you still have to be prepared and not get caught off guard when you move into the house and all of a sudden the garage door opener stopped working and now you got to get that fixed and it's $200. Where's that money coming from? Surely not on a credit card. So in order to be prepared. So when it comes to savings, in terms of the amount that you need to save, your first goal should be $1,000. If you don't have any money saved at all, you're starting from zero, or you got $25, or you got some dust in the savings account, you can start with $1,000 as your first goal. Once you've met that goal, then your next goal is to figure out, how much does it cost to run my house? If I'm looking to buy a house and my mortgage is going to be, first of all, find out what is the estimated amount that mortgage would cost you per month. And if the house is going to cost you, example, $2,500 a month, then you need to do a budget based on what that house is what the budget will look like if you purchase this house, along with my electric bill, my gas bill, my cable, all these things. What is my outgoing expense for the month? And that is how much money that I need to set as my next goal. So if it's going to cost me $3,000 to maintain my house, then my next goal needs to be $3,000. Why? So that I can have a 1 month cash reserve. That's what that number would represent. How much does it take if you lost your job tomorrow in order to run your house? This is how much money that you have to have. Gosh, I'm at 15 minutes already. I'm going to hurry up. So you want to make sure that you've accounted for that. And so once you've set that goal, then you set your next goal, which is a 2 month cash reserve. Once you know the 1 month, then you know what the 2 month is. So as that allows you to be more strategic and say, okay, in my budget, I've determined I can save $300 a month. Okay, well, now I know how long it will take me to get to the $1,000 a month, or $1,000 savings goal. And then if your next goal is 3,000 and you're putting aside $300 or $400 a month for savings, and you can do the math and figure out how many months it will take you to get to that 2 month or that 1 month cash reserve, and then list it. There's something to be said about being intentional. We don't need to save willy-nilly and say, oh yeah, I just set aside money with no strategy. That's just putting money in a savings account. That's not actually a savings plan. So you got to have an actual plan to say, all right, if I need $10,000 to buy this house, where is that money coming from? How am I going to get there? And when am I going to get there? You can actually have a goal date and not just have a random idea. Well, hopefully sometime next year. No, you need to actually put a date to it. Hold yourself accountable for what it is that you want, because it's out there and you can have it. That is really the bottom line. Number 3, when it comes to debt and credit, obviously you want to be in the best possible credit positioning when you're purchasing a house, because you want to have the best possible outcome. Who wants to be stressed out just hoping that they're going to be able to get approved to buy a house because you haven't done all the proper steps to make sure that your credit is in position? Again, this is about being intentional. Let me make sure I got my budget, that I know exactly what I can afford, because that's going to empower me and make me feel more comfortable and confident in my home purchase when I'm talking to the real estate agent. It also brings them comfort, if the truth be told, for the real estate agent to feel comfortable in working with you when you know that you have your finances together. So if that means that you need to take the time to pay off a few debts in order to get into a better financial position, then don't be in such a hurry to get in the house that you haven't done all the other stuff, because now it's going to make it that much harder after you move into the house to then turn around and say, okay, now I'm going to pay off these debts. So the better you set yourself up, the better experience you're going to have all the way around. Everything, one thing affects the next thing. So it's important to get your credit into the right positioning, and you'll find out from the lender what that credit score needs to be. And then from there, that helps you to be able to plan from there to know, okay, well, if I have a 620, and he's telling me this is what I'm approved for based on 620, but if I just take care of a few debts and get my credit score up to 640 or 660, then, I'm going to have this particular interest rate, then that's going to give you a better positioning as well. Number 4 of your financial plan is life insurance, making sure that when you purchase this home, if it is your intent that I want to make sure that I leave this house behind for my family, then I'm able to, then you want to purchase a mortgage protection policy so that if God forbid, something happened to you, that house can be paid off and your family won't have to suffer a hardship because now you're no longer here. They're able to maintain the lifestyle that you are setting in place. So having that life insurance is also a crucial part of your financial plan, not just for the house, but also just in general, if they are dependent on your income to survive. And then lastly, number 5, key area of a successful financial plan is making sure that you have thought about your retirement and making that a part of your strategy as well. So when you're planning for the house, these are your key 5 areas, because this is a long-term investment. You want to make sure you've covered all 5 of those areas. I have my savings. I have my budget. I'm saving like I'm supposed to. I understand how much I'm supposed to save. I'm making sure that I'm taking care of the debt as much as possible and making sure my credit is in the best possible positioning. I'm making sure that whatever I need as far as life insurance, I got those parameters in place. And I'm also making sure that I can be able to retire after I'm buying this house. All of those key areas are vitally important. And if you do those things, you will absolutely have financial success coming out of a divorce, buying a house, and beyond. So it's important to position yourself for financial success. Here is all of my contact information here that you can also take the QR code. If that will also connect you to all of my social media platforms, to our podcast where we talk about other financial topics. And we also offer free 15-minute financial consults. So if you have any questions about anything, or you just want to have a quick consult and see, if there's something you need to be doing or need some help with something, feel free to reach out to us and we're more than happy to help. Thank you so much, Janelle.
Thank you so much. Some great information. We've talked about the 5 points that we need for a successful financial plan. And so now what we're going to start talking about is on the lender side of it. What exactly what the lender would need in order to get you set up when you now made the decision, now I'm going to get out here and purchase a home. So we have our lender, James Adamson. He's from Ameris Bank. He's one of the lenders who has helped a lot of our clients successfully on their purchase of their home. I give kudos to Breanna. She's actually my financial counselor also. I work with her for, it's been almost a little over a year, and she has definitely made some significant progress with me as far as shopping and things that I need to take care of that I never even really thought about until I started working with her. So, James, after divorce with the Ameris Bank, take it away.
All right. So my name is James Adamson. I've been in the mortgage industry for over 30 years. I was asked to come here and talk about financing after divorce, which we're going to go over. And a little of this is going to bleed into before and during the divorce too, because the things that you do during that period can affect how the outcome is when you go to buy a house after a divorce. So we will be kind of going a little bit of back and forth and suggestions that I have on my end. So the first thing we want to look over are issues to consider. These are, covering all the bases, credit cards and loans, properties owned, alimony, child support, how that plays into when you're buying a house, and seeking professional help. So the first one we're going to go over is covering all the bases. So when you are a party of a divorce, reestablishing your financial status as a single person is the most important things you can do. Take care of the red tape now can avoid financial problems down the road. So we're going to go into more detail about that. But basically, when you're married, you're going to have a mixture of your own personal credit cards, joint credit cards, you'll have authorized credit cards, and we're going to go over into more detail how those things should be separated and how that should be done so that it does not affect your scores after the divorce and does not prevent you from buying a house. In some cases, right after the divorce. So we're going to go into more detail on that. So the first one we want to cover are credit cards and loans. And advantageous first step is to obtain a copy of your credit report, which some people don't think about. It is very important during the divorce to get your credit card or get your credit report pulled, and it's very important during that time that it be pulled by all three credit bureaus, not just one, because you want to know all the credit that's out there, and it should be done by both parties on both sides. But especially for your purposes, the person that is getting the divorce from the ex-spouse, you want to pull your credit so you can identify what accounts you have individually, what accounts you have jointly with the ex-spouse, and what accounts you might be an authorized user on their card. The accounts that you have that are individual, you will want to keep open because those are more than likely already established. They're helping your credit score, and any of those you close could affect the score. So, and you also want to identify any outstanding balances on any joint accounts. Those should be paid also. It will also indicate which accounts are solely held by you individually, which accounts are held jointly, and designated as authorized users. So again, it kind of gives you a blueprint on what accounts need to be tackled. Having an established and independent credit history is paramount and important, in addition to maintaining existing clean credit accounts and keeping your credit scores high. So what I mean by that is if you close all your cards during this divorce and then go to buy a house, you have no credit history. More than likely your scores would have dropped. So it's not a bad idea to get with a lender, maybe have them pull your full credit report so you can see exactly what's on there, and they can kind of guide you into what you should close, and give you advice on what you should keep open, and kind of help you through that process so you don't do something that could take a year to fix. The next one is continuing on the credit cards. Prior to opening any new credit, remember the following. When you open a new trade line or credit card, that will lower your score out of the gate because there is no credit history on it. So the things to remember is if you're going to open new cards, you need to go into it knowing that you're going to need at least a 6-month to 12-month seasoning on that credit card to give you a decent credit score on your credit report. Because when you open a new card, it's got to have time to season. So it's not going to help boost your scores right out of the gate. The other thing to remember is during that seasoning period, do not let the credit limit ever get higher than 30% of the high credit limit. So, some people will say, well, I pay off my credit card every month. Well, the problem is that the credit bureaus do not report every time you pay off your credit card. They report one time and one time only a month. So if you've charged up your credit card and they happen to report it on the 15th with the credit bureaus, and then you pay it off on the 17th, the credit card company or the credit bureau doesn't see that. They just see a high balance credit card because it hasn't been reported yet. So never let the card get above 30% of the high credit limit. That'll avoid that. And of course, always make your credit card payments on time. That's self-explanatory. Jointly held accounts, if feasible during the divorce, if there's a joint account that you would like to keep open, if feasible, go to the creditor and see if that account can be transferred over to just your name. The reason for doing that is that card is probably already established with the credit bureaus. So it's helping your scores, giving you those higher scores. Once you close that card and open a new one, as I said, the credit score is going to drop because now that credit revolving card, once you close a revolving card, it does not affect your scores anymore. Even if you paid it on time for 10 years, once you close it, it will not count towards the credit scores. So it is important that if you can, try to save as many of the established credit cards that you have as possible. So if the creditor will let you transfer it over into your name, you always want to try to do that. The goal is to limit the damage to the credit report as much as possible. And in those cases where that credit card company or creditor won't do it, then of course you're going to pay it off and close it. You don't want to keep a jointly owned credit card with an ex-spouse. We'll go into that in more detail. Okay, so going back to what I was saying before, when you have jointly held credit cards and you are involved in a divorce and you keep that card open and the spouse says, I'm going to make the payments on it, you are still, as far as the credit card company is concerned, responsible for the mortgage. They don't look at the fact that there may be an agreement in the divorce papers that say, the spouse is responsible for these credit cards. If those credit cards are jointly and that ex-spouse stops making payments on time, they can still legally come after you because you signed for the card and it's going to affect your credit. So the goal during a divorce is to separate your credit from the ex-spouse and to make sure that there are no possibilities of something like this coming up. Once the divorce is over, trying to get a credit card, a jointly owned credit card closed by both parties is going to be difficult. And again, if they're late on that card, it's going to reflect poorly on your credit. So you want to make sure that those accounts are either transferred into the ex-spouse or your name only, or are paid off completely and closed. So that's the goal, to separate the credit and have your own. It's important to remember that any joint accounts left open after the divorce for which an ex-spouse is responsible for are ultimately your responsibility, as I said. Even if a legal divorce decree or separation states the ex-spouse is responsible for the payments, the credit bureaus and creditors don't take that into consideration. If an ex-spouse makes late payments or stops paying, it will reflect negatively on your credit. This is why it is extremely important to completely separate your credit from the ex-spouse. Properties owned. If a real property is owned jointly with your ex-spouse, the associated mortgage lender will not permit you to remove either person from the note. They do not there's never been a case where a mortgage lender was, okay, yeah, here, you send them the divorce papers and they take the ex-spouse off. That's not how it works. The only way to remove an ex-spouse is to, one, refinance, or two, sell the house. Those are your two options. Or if you have to, purchase it. So it is important to remember that during a divorce, if you want to keep the property that you currently own, you will have to do a refinance. In this case, a refinance will need to be completed, and whomever is retaining the property must be able to qualify on their own. In some cases, a time frame is established for the ex-spouse to refinance the property. I've seen divorce papers where, it says that the ex-spouse will retain the property and has this long to refinance. Here's the problem with that. I just had an example of a loan I was working on for a client who was divorced 10 years ago. His wife still has not refinanced the property. So, and that goes both ways. So once you've done the divorce papers and you've given this person time to refinance, that does not mean that it has to happen. There's cases where it's like in this case, 10 years and they still haven't done it. And there are late mortgage payments on the mortgage that reflects your credit. If the ex-spouse is living in the house, and even if the divorce decree says they're responsible for the payments, again, the mortgage lender doesn't recognize it. You are both equally responsible, and that late payment will be reported on your credit report too. So you need to keep that into consideration. So it's always best to either, sell any jointly owned properties. And if it's a case where the ex-spouse intends to keep the property, then there should be a requirement that they meet with a mortgage lender or loan officer and provide proof that they can qualify on their own to purchase or to refinance this mortgage out of your name. That way, the refinance is going to happen, and you could push it at that point. Again, if there's a time frame given, that gives the opportunity the person to never refinance, and that mortgage is going to sit on your credit report also and look like a debt that you owe. So if it cannot be refinanced early on, sell it. So that's just something to remember and take into consideration on properties that are owned jointly. Here's some questions that people have asked me in the past is like, well, I'm not on the mortgage note, but I'm on title. Would I have to purchase the property? In that case, no, it would still be considered a refinance, and you could refinance the property into your name as long as you qualify. So you just either have to be on the mortgage or the title. If you're just on the title, that's fine too. If a person is not on title or the mortgage, and you're the ex-spouse wants to keep the property, then it will be considered a purchase because they have no ownership in that property. And a gift of equity could be used to purchase the property prior to divorce. And the reason I say prior to divorce is while you're still legally married, a gift of equity is allowed between a family member. So at that time, you guys are still family members. Once that divorce is finalized, signed off, and the court has agreed with it, you are now no longer married and you are no longer family. So at that point, the other person cannot give you a gift of equity to buy the house. So that's just something to keep in mind. A lot of questions we get after a divorce are, can I use my alimony / child support to help me qualify for a new purchase? This is one of the most, often questions we get. So the following are agencies have different guidelines when it comes to the use of alimony and child support for qualifying. So one of the questions is, how soon can I use alimony for qualifying? Conventional, you have to have a 6-month payment history of it consistently. Same amount, the amount that's on your agreed payment on your divorce papers, and it has to be made for 6 months. For FHA, VA is 3 months. For USDA, it's 6 months. And the same applies for child support. So it would have to be on the divorce papers. The payment, the child support payment amount would have to match exactly every month for 6 months conventional, 3 months FHA VA, and 6 months USDA to use that income. FHA has an exemption for non-court ordered alimony / child support, which I see sometimes, where the two parties have agreed that, you know, just pay me this much, and it's done outside of the court system. When that is done, we can use that amount also, but you know, if it's not consistent, like if it jumps around from payment to payment, like he pays one lump amount on a 1 week and then you've got to wait 5 more weeks and he pays another, then the only way we can use that is to average it over 12 months. So you'd have to have received it for a year. Also, the time frame that you receive these is important too. There has to be 3 years remaining on the agreed alimony and child support to count it. So if it's a divorce situation and the child is 18 years old and you're getting child support, that's not going to be able to be used because it's not going to continue for 3 years. So they will look at the time period that you're going to get it for. And really the next one, again, you need to seek professional help in all these categories when you're purchasing a house. During this time, emotions are high. There are many things, you know, you're trying to think of and consider, and you know, it's not a good time for anyone. You don't want to make any, you know, rush or rash decisions that could come back and haunt you. And again, these are things that could come back and haunt you 10 years later. That's why it's very important that you know, you try to separate that credit right out of the gate. Close any joint accounts unless you can get them transferred into your name. If they can't refinance into that property right away, then sell it, because you know, it could come back to haunt you later on. And you should always have, of course, a good attorney, a good financial advisor, lender, and realtor helping you through the process, because you know, each of those phases are going to come into play during a divorce. And it's better to plan during it than it is to try and figure it out after it. Because once the divorce papers are done and the papers have been submitted to the courts, if there's joint accounts out there, and you know, it could create a problem. Just one additional thing I'd like to add too is that, you know, I'm kind of referring back to that other case, the ex-spouse, it'd been 10 years since she had not refinanced, and he can't buy a house because she won't provide proof that she's been making the payments for 12 months. So even though the paper said she had to refinance within a certain period of time, and I see this both ways, you know, he can't buy because I have to count both mortgages payments against it, because he can't get me proof that the ex-spouse is the one making the payments. So again, you know, it's all about planning, you know, not trying to do it yourself, going out there and getting help, and making sure you try to cover all the bases during that period so it does not come back to haunt you later. And that's it.
I think there were some really great points that were made, James. Thank you. And we've covered the financial aspect of it with Breanna, and she's giving you the plan for, okay, so now you've got the house, or you're thinking about getting the house. The things that you need to consider, because like she said, we don't put you in a house just to put you in a house, and the next thing you know, your house broke and you're calling us the next year to sell the house. That's not our goal. Our goal is that when we find you your house, it becomes your home, and that you have these points and things put in place so that you can, you know, be happy in that home, because that's the whole part. The whole part of home ownership is to be happy. And then, you know, because the divorce is not the end of life, but it's a lot easier when we prepare with a plan. And so, we've learned some financial things. We've learned some things that the lender's going to need. And the great thing that I think James said on his point also was when he talked about, when we make those decisions in the process of going through our divorce, that, okay, well, a person can stay in the house until a certain amount of time, that maybe we should make sure that that person has the ability to afford the house and can qualify for the house, so that you're not at a point where now you're stuck on the mortgage with someone that you thought that could qualify for the house, that we find out that can't qualify for the house. And now all of a sudden we're in a position where we can't go to the next chapter because this person hasn't done that chapter. So a lot of housekeeping things that we need to make sure that we take into consideration as we go through the process. And we also get a lot of questions about alimony, child support. I really love the part where that we now know that, just like that 3-year timeline. A lot of people, they have kids that's getting ready to turn 18 and they still trying to use the child support, and it's not something that can be used. So I just think that we had a lot of great information. Is there anyone that has any questions that we can ask our panel? Well, with that, I want to thank you both for joining us this morning. I mean, it was some very insightful information. For those who would like to get a recap of this, we will have this posted on our YouTube channel and also on our Facebook page. Breanna, you gave your information on how they can reach out to you. James, can you give their information should they want to reach out to you?
Yeah, my contact information's there. The cell phone number is 301-717-6272. And my email is james.adamson, ADAMSON, at amerisbank.com. That's AMERIS bank.com.
Well, we thank you for joining us. As I say, Breanna, she's been my financial counselor for a while. She is awesome. James is one of our partner lenders. He is awesome. We can vouch for them both. And if you should have any other questions, feel free to reach out to us. You could either text us, email us, ask questions on our Facebook page. And again, these will be available for you on our YouTube channel also. So thank you all for joining us again, and have an awesome day on purpose.